All right, everyone. Special guest today. I'm back with Troy Cates from NEOS, co-founder and managing partner of NEOS. Troy, thanks so much for taking the time. How's it going?
Good. Thanks for having me. Looking forward to our conversation today.
Yeah, today I want to talk to you about NUSI, NUSI ETF, which seems used to be at Nationwide. Correct me if I'm wrong, but you guys were actually the managers of that, I believe, at Nationwide, but it looks like it's come back to the NEOS umbrella. So tell me a little bit about why that happened, how that happened, if you don't mind.
Sure. No, it's a good question, and I think we've started to have a lot of conversations around it now that it is part of the NEOS ETF suite. So NUSI was the nationwide risk managed income ETF, and we had Garrett and I had been portfolio managers since inception back in 2019. So we were a sub-advisor for the fund.
Okay.
Nationwide was the advisor, and we managed it over the years for them. And as they were looking to potentially get out of the ETF business and focus more on their core business around annuities and other parts of the business, we really wanted to continue to manage the product. So we had talked to them, and we basically then, after we agreed on how we wanted to take it over, we had to go through a proxy process where all shareholders are reached out to and they could vote yes or no or abstain. And basically, it took a number of months to get through that proxy process. But now it officially came over in the middle of November. It is now the NEOS NASDAQ-100 Hedged Equity Income ETF. We're really excited to have it over here and happy to walk through with you what we've kind of changed and what we've kept the same. Because there are, a lot of assets in there, a lot of shareholders that we've talked to and known over the years that really want to understand how the products might change going forward.
Yep, that was actually going to be my next question. Can you explain exactly what this ETF? This is the NEOS NASDAQ 100 Hedged Equity Income ETF. So obviously based on the NASDAQ 100 index, you have the management fee here, you have the distribution rate here, which I believe is on the last, based on the last distribution. It's a monthly payer. Can you please explain to the audience what NUSI is, what it does, how it works?
Sure. So, what it does now, we're still, and I'll look at what it did before and what it did now.
Sure.
Prior to us taking it over, it was long the NASDAQ 100 stocks, and on a monthly basis, we would roll a net credit collar where we were selling a call, bringing in an income, and buying a long put to hedge part of the downside and give you a measure of downside protection. What we've done since then and how we changed that is we basically put in some of our more rules-based strategies that we use on some of our other ETFs here at NEOS, whether it's SPYI or QQQI on the high income side. We basically moved the roll date, so we're rolling at the end of the month. The duration is a little longer than a month, so it's very similar to how QQQI operates. But we're selling a call, still selling a call to bring in income. And instead of just buying a put and trying to hedge a part of it down to zero, we're basically buying a put spread. So we're buying a put a little out of the money and then selling a put further out of the money. So we're basically want to make sure that as the markets come in on a monthly basis here or there, we want to have a measure of your downside protected with that long put spread. We're not trying to hedge you out to zero. We're not looking to do that, but we're looking to basically buffer or hedge a part of your downside on a monthly basis. And then on the upside, we have our rules-based strategy that's managing the short calls, very similar to how we do with QQQI or SPYI, where our rules-based strategy is looking at volatility, the rate of change of volatility, and deciding how much, not only how far out of the money the call should be written, but how much of the notional should be written on for the short calls. So to think about it right now, just to give you a live example, we're about
Yeah.
75% covered on the short calls, but the long put spread is 100% covered. So if the market moves down, we wanted to make sure we did have that measure of downside protection. But on the upside, if the market moves higher, we want to be able to participate with those market moves higher. So a little different. And I think you'll see over time that should smooth out the return profile compared to how the product was before, offer maybe a little bit more upside on some months where the market does run higher, but also bring in a little more income because we're not spending as much income buying that long put because we're selling a put below it. So I think as you'll start to see The income has traditionally been in the 7.75% to up to 8% range. We just had our first distribution, so it'll definitely update on our website next month, but it's more in the 8 to call it 9% range going forward should be where you see it.
Yeah, a little bit higher with the latest distribution,
Exactly.
18.6. So like you said, okay, so this number is going to be changed a little bit higher. So in layman's term, if I understood correctly, it sounds a lot like your other cover call strategies like SPY-I. Well, it's actually QQQI would be the best comparison because it's the NASDAQ, about 75% covered in terms of writing the short call or the covered call.
Yep.
But on top of that, you're just adding a put spread to give you a little bit more cushion if the NASDAQ goes south. Do I have that right? So
Yes.
would I would you consider it, or could I say it's a little very similar to QQQI, which I'll ask you about in a second, with a little bit more downside protection than QQQI?
Yes, the only downside protection you'll get with QQQI is really the income we brought in off the short calls. So in the
Oh,
flat to
okay.
down months, you'll outperform by the amount of premium we brought in off of those short calls. So there's no real hedge on QQQI. Where NUSI, what we're trying to do there on NUSI is make sure you do have an actual hedge on the downside to give you a measure of downside protection for those times where the market does sell off.
Interesting. And you could see the yield difference. So you're looking at a lot more yield with QQQI, in the 14 range. And with NUSI, it's about 8 to 9. So would you say in terms of risk profile, I'm just trying to, make my audience members understand, you got QQQ or QQQM, which is a pure NASDAQ 100. Then if you are an income investor, you want some income, you still love the NASDAQ 100, a little bit of downside protection exclusively with those covered calls, a little bit lower risk, I would say, a little bit lower beta than QQQ or QQQM would be QQQI,
Yes,
correct?
you're definitely thinking about it correctly. Because you're bringing in that income, you will have that slight buffer on the downside, or those flat months you'll outperform a little. Yes, on the big up months,
Capped, a little bit
where
capped.
you're capping yourself out eventually to bring in that income. But again, through our rules-based strategy, we're not always overlaying close to 100% of the notional. So you still have part of the portfolio that can continue to participate in the markets when they're moving higher.
Right. And then NUSI would be slightly less risk than QQQI because you also have a little bit of extra protection. So do I have that right?
Yes. So you think about it, if you want NASDAQ 100, but you want some income and you're still willing to take a lot of equity risk with it, you'll get rewarded for that equity risk with a higher distribution rate in QQQI. If you want to still have that NASDAQ 100 exposure, but you're willing to take a little less risk, you want to smooth out your return profile, lower your standard DEV, and lower your overall portfolio volatility and have a measure of downside protection, NUSI would be a good choice for you.
Makes perfect sense. So, you have a few other options. So it just, I guess it really depends on how conservative the investor is that wants to invest in the NASDAQ 100. So you actually have two ways. NEOS is offering two ways to do that instead of one now. With the same expense ratio, I believe,
Yes,
NUSI and QQQI, as well as SPY-I and your S&P or Russell one, I think, all have a 68 expense ratio. Okay.
correct.
Perfect. So and by the way, I really like what you did on your website. If you go to resources, you see comparisons. I really like that. So if we just click on QQQI comparison, because we're actually talking about the NASDAQ 100 today, QQQI is basically being compared. This is total returns. If I'm not mistaken, you have
Yep,
the dates here.
correct.
So the start dates are all the same with not only QQQ, which is the pure NASDAQ 100, but also some of your biggest competition. I think JEPQ and QYLD are pretty much the biggest in terms of AUM or close to
Yeah,
it.
we put these up because this is what people ask us about when they're looking
Uh-huh.
at the space. Advisors we talk to are looking at some of these competitor products and they want to know how we compare. And one of the important things that we show is not only the total return, which you pointed out from our inception in early January, but that nice upside capture of the NASDAQ 100 represented in QQQ, but also our distribution rates. And some people look at it and that's all they want to discuss, but we also dive in, and I know you and I have talked about this before. We talk about the tax efficiencies of QQQI using index options,
Yeah.
and what we're doing there with harvesting losses in the portfolio throughout the year. versus say a JEPQ, which is using equity-linked notes, and those are all taxed at ordinary income rates. So a very different tax standpoint where we're using the index options that get that 1256 rule from the IRS and give it a 60% long-term, 40% short-term capital gains as we roll those option portfolios on a monthly basis. So it's always good for us when we're diving deep into what we're actually doing in the option portfolio, but then exactly that net after tax distribution, I think, is really important for people because at the end of the year, they get their 1099 and they figure out what kind of taxes they owe on it. So for us, that net after tax distribution is hopefully we could get it as close to the gross distribution as possible.
Yeah. Yeah, for sure. Yeah, it's a lot of concern. It's a major concern I get from people. I'm sure you do. It's same for you guys, taxes, right? Because these are high yield, so people are worried about taxes. But that's what I love about covered call ETFs, especially index options. Like you said, you could transform them into more tax efficient distributions. And if ever, people want to, you guys are basically showing what they are on your website, right? You also have a nice little video that talks about rock, which is we've discussed this before, very
Yep.
misunderstood because typically with covered call ETFs, especially that do index options like you guys, you will have a significant portion of the income, which is rock. A lot of people associate that negatively, but it's not the case. It's just the way the index or the tax classification or the accounting is in the US. So
Yes,
yeah.
exactly. We're not looking to return principal, but if we can get part of the distribution classified as a return of capital from an IRS perspective, that just defers their taxes down the road. It does lower your cost basis, but instead of paying an ordinary income tax rate this year, you might defer it down the road and potentially just pay a long-term capital gains at that point if you decide to sell the product at some point.
Yeah, you said something very, very key there. We're not looking to pay out our capital. That's what, if you look at the definition, return, ROC is return of capital, but you guys are not doing that, which means you're not overpaying what you're earning,
Yes.
correct? Yeah,
Exactly.
always
We're
a
not
major.
looking to over distribute. The space has grown a lot. There's a lot of products out there. And I think for us, we want to make sure that the distribution that's being paid out can be supported by the total return of the product over time. So we're not looking to over distribute. We find that where our products, whether it's QQQI, NUSI, SPYI, any of them, where they fit and what their distribution rates are very appropriate for what the total return of the product should be over time.
Yeah. Yeah, and obviously investors really like your products. I think SPY just passed 2 billion. Your QQQI, which I don't even think it's been a year, is crawling to a billion already. Very, very impressive here. And I mean, the returns speak for themselves as well here. You could see how, in a relatively, obviously the NASDAQ's a little bit more volatile, but it's been mostly a bull market where covered call ETFs tend to underperform. And you're right there next to the QQQ performance. You're beating some competitors. You're right on par with JEPQ right now. So I think this is fantastic. And I really love that you guys added this to your website. And I believe that even the distributions, investors could go and check each distribution every month to see how much is ROC, how much is short-term, long-term capital gains. Is that in the fund material? I think I should have checked this
Yeah,
before.
there's something that we post on the website, which is called the 19A1 notice. Now, this has to go out for regulatory reasons, but it's basically saying, there it is right there, supplemental tax information.
Okay, here
It's
it is.
basically saying what could be a worst case scenario and looking at what a potential return of capital could be. So I think on these notices, it's usually higher than it is, but the actual return of capital, QDI information, long-term, short-term cap gains, how the 1099 at the end of the year that you get is broken down isn't done till the end of the calendar year. So this is just a supplemental information that needs to be put up on a monthly basis that investors can look at and understand, but it really doesn't get pulled together till year end from a tax standpoint.
Okay, perfect. Yeah, I mean, it's a favorite with some of my audience members because the yield is high, the returns are really good. The distributions are actually very, very consistent as well. So it's really, people like it, especially that are living off of this income. Yeah, I mean, and you have the distributions right here. You could see, obviously, they're going to vary from month to month based on the NAV and volatility. You see, we had a pretty volatile August that went up a little bit. Now it's back to in the 60s, but you're looking at basically a very stable, approximate 14% yield here. So Thanks so much for your time, Troy. I really appreciate it. I encourage my audience members to check out the other Q&As that we did where we discuss your other ETFs. And I'm talking to my audience members here. Don't forget, besides QQQI, they also have the same strategy that they're doing on the S&P 500 with SPY, which is over 2 billion in AUM. They have one for the Russell 2000 index as well, and other ETFs as well relating to cash and fixed income, which we discuss in our Q&As, which I'll put the link in the video description below. So Troy, as usual, thanks so much for your time and hope to have you again soon. We'll be following closely NEOS products in the future.
Thanks for having me.